It's not that the poor person has a different insurance policy from the rich person, or that they would therefore go to a different doctor, to different healthcare providers. No, at the point of getting sick, you get the same healthcare as anyone else.
I wonder whether social health insurance is enough in the long term. I don't think they have a kind of coherent mental model of inflation and how they are controlling it. Whereas the Shadow Monetary Policy Committee, it's not a kind of ideologically homogenous group, but broadly speaking, it is a more monetarist body.
According to the ONS, their figures last year, the gender pay gap is around 14.8% for full-time work. Now, the problem with these statistics is welcome back to the Institute of Economic Affairs podcast with me, Reem Ibrahim, the IEA's Acting Director of Communications. Today I am delighted to be joined by Tom Clougherty, the IEA's Executive Director, and Kristian Niemietz, the IEA's Editorial Director. We bring you a current affairs podcast with a difference. We want to go beyond the headlines and look at the foundational principles that matter to classical liberals. Today, we are going to be discussing whether we need to replace the National Health Service with a social health insurance system in order to save lives, this week's inflation rate and what that has meant for the Bank of England's decision to freeze interest rates, and we're going to be discussing Rachel Reeves' plans to tackle the gender pay gap. Kristian, why do you think we need to transition the National Health Service into a social health insurance system?
Yeah, first of all, the reason why I wrote this is that I've noticed that over the past two and a half years, it's become a lot more common to talk about this alternative. You know, when I started writing on this, there was pretty much nobody else doing this. And it was at that time a unique selling point for us. And over the past 2.5 years, it's become a fairly, well, I wouldn't say a mainstream position, but it is no longer an exotic position. You can now quite often read articles in The Telegraph, The Times, The Spectator, where they would say, actually, the health system that we have here is falling behind others in terms of outcomes. It doesn't deliver, whereas there are better alternatives nearby that preserve all the features that people like and value about the NHS. So why not go for something like that? And then I thought, well, yes, I've been saying this for a while. Finally, I wouldn't go quite so far, but I'm no longer totally hated by everybody. So that's the first step. But one problem that we still have with this discussion is that a lot of the people who now make the case for social health insurance systems are new to this. And so therefore, the standard arguments that you read about this, they're often a bit, well, you don't get a full sense of what such a system would look like. And perhaps more importantly, what they don't usually do, people who write about this in the media, they're not going to tell you what the roadmap could look like from the system we have to the system where we would ideally want to be. And fair enough, that's probably not something you can tackle in a newspaper article, especially if you're not a full-time health correspondent. But nonetheless, I thought, well, now that the debate around this has reached the stage where there are various prominent advocates of social health insurance systems, where that is no longer an exotic position, now it is maybe time to go that extra step and spell out this is how you would this is how the transition could work, and specifically I've looked at the experience of countries and regions that have already done this in the past. So just to make clear, this is not as unprecedented as it may seem. It may sound like a radical proposal to transition from one kind of healthcare system to another, and it is true that doesn't happen often. It's not that there's dozens of examples to choose from, but there are a few, and none of them are exactly comparable. I'm not saying there's anything that we can copy and paste, but it has been done, and what it shows is simply it does not need to be disruptive. It doesn't mean one of the where it was covered in the media today, they said think tank calls for scrapping of the NHS. I specifically say you don't need to scrap anything. You just need to make sure you need to create a framework in which one kind of system can over time morph into a different kind.
I think what's really interesting is, so the report we published this Thursday, and it came obviously a week after Lord Darcy's review. So we know that Lord Darcy himself has sort of said in his report that Wes Streeting, the Health Secretary, has supported that the National Health Service is broken, but there seems to not be much agreement on what a potential solution could look like. And actually, these kind of mechanisms, the sort of market mechanisms of choice and competition, allowing for patients to have that kind of choice, but also there being competitive pressures between different providers. Actually, this is a system that is workable. And in the paper, you sort of outline a couple of points that actually there are ways that you can use existing NHS infrastructure to slowly morph the National Health Service into a more competitive model. I was going to say, what do you sort of think about, what do you think the key elements of that would look like, and how can we actually get to a point where there is competition between providers?
And actually, can we start just one step back from that, actually? And what are the essential characteristics, Kristian, of a social health insurance system that make it superior? And as I understand it, when you look at the evidence, the cross-country comparisons, you can kind of divide European healthcare models into beverage models, which kind of work like the NHS, and Britain has the main one, and I think some small Scandinavian countries, for example, have NHS-type systems as well. On a smaller scale, they tend to work better, but they still tend to be outperformed by what are sometimes called Bismarck systems, so social insurance systems. But what are the essential characteristics? Why is it superior, seemingly, to the NHS? And then Reem's question, which is a very good one, how have you identified that we can get from what we have now to that social health insurance model without massive disruption, without scrapping healthcare?
No scrapping.
As people on Twitter were suggesting today.
Yes, well, the basic features are, at first sight, it does look like a conventional private insurance system. You would just think of health or illness, sickness as an insurable risk, like any other. And when you get sick, rather than paying at the point of use, there would be a third-party payer who covers the bill, and that third-party payer would also be an active commissioner of healthcare, so they're not just passively reimbursing costs, they're trying to organize healthcare delivery. In that regard, it's very much like a commercial private insurance system, but the big difference is that the premiums that you pay are not related to your individual risk, meaning sick people don't pay more than people in great health. So that is what makes it a social insurance system rather than just a conventional insurance system. And so in that regard, it preserves what people value most about the NHS, that you have equitable access. And I should add, there's also this in social insurance models, there's always a system of premium support, so that you can't get to a situation where you can't afford to pay your premiums. There would always be a safety net for that. But safety net doesn't mean that there's somehow a separate insurer specifically for poor people, like in the United States with Medicaid. It's not that the poor person has a different insurance policy from the rich person, or that they would therefore go to a different doctor, to different healthcare providers. No, at the point of getting sick, you get the same healthcare as anyone else. You can have the same health insurer as a rich person. It would just be, if you're rich, you pay for it yourself. If you're not, it would be paid for you. Or part of it, depending on how poor you are. So those are the basic features, and in that way they combine some of the things that we like about markets, that you have the freedom of choice, that healthcare providers and healthcare insurers have to offer you something that you like, and that they have every interest in making sure that you would recommend them, review them positively, stay with them. And they are dependent on you, the customer, for staying in business. So that is something that we would like about them. But it also has things that proponents of a socialized model would like, which is the universality and the non-discrimination. So it has all that. It also has some features that I think somebody like Lord Darcy would like. I think I mentioned this on the last podcast, that he talks about how there are too many commissioning organizations within the NHS. Well, that's a problem that doesn't appear in social insurance systems, because if there are clear economies of scale in merging commissioning organizations or any type of organization, you don't need politicians to take the decision to merge them. It would just happen as part of a market process. And where even some of the critics of those systems concede, so people at the Nuffield Trust who have criticized that kind of system, one thing that they concede is that they are less politicized. So you don't get the political risks that we get in this system, which are, well, one of them being that every time we have a new government or a new health secretary, and we've had quite a lot of rotations, every time there's a new one, they try to somehow leave a mark. They want to show that they're doing something, that they're somehow different from the predecessor. So what do they do in this system? Well, they reorganize something. They scrap something. They scrap some part of the NHS, replace it with something new. Quite often, you then look back and think, well, what was that about? That seemed like a pointless reorganization. So, for example, on the commissioner side, since I started writing about this, when my first paper on this came out, these internal commissioners were called the primary care trusts. Then, when the Conservatives came to power, they scrapped those, set up new types of organizations that were called the clinical commissioning groups, and now they have been abolished. They're now called something like integrated care boards. So you get a lot of scrapping and building something new, and that is a political risk in the system we have, that you have politicians just meddling with the system. That doesn't happen, or at least not to anything like that degree in those systems, because the health secretary just isn't involved at that level. That is not their choice to make, and that's something that's not specifically my argument. That's an argument which people from the Nuffield Trust, from the King's Fund, who are critical of SHI systems overall, would concede. That's something that they have also said.
It's so interesting because I think that politically, and this is something that we have spoken about, is that the fact that we can now criticise the National Health Service and talk about alternatives and be taken seriously in the debate, I think is so fascinating. And actually, it really does show that the Overton window has shifted. I think the YouGov polling that was published last week showed that in 2021, 11% of the population said that the National Health Service was worse than European healthcare systems. And now we're at a stage where it's just below 30%. So clearly that there is a shift happening, and it's happening rather rapidly. What's interesting, I think, about some of the implications of this kind of SHI system that you propose in the paper, you talk about the potential for experimentation, and actually there are all of these different outcomes that we could obtain as a result of this kind of system, where patients are able to choose their healthcare providers, and if they don't like one, they're able to move to another, and bad providers are able to be taken over by better ones, and you see those kind of improvements and efficiencies. Could you talk a bit about what the experimentation process actually looks like and why that is indicative of a market process?
Yes, so one of the problems here is that it's been part of the healthcare debate for a long time that successive governments have said, we want to take the politics out of it. We want to give healthcare providers greater freedom to do their thing. They are the experts. They are the professionals. We're politicians. We don't want to be involved on a day-to-day basis. It's not something you can realistically do in a nationalized system, because when something goes wrong, people will still, for better or worse, blame the politicians in charge. So quite reasonably, they will then say, no, if we get the blame, we also want some degree of control over what happens. Whereas you can only really have autonomy at the healthcare provider level if they have to take responsibility for the outcomes. And that ultimately there has to be that threat even of a provider going bust, even if that almost never happens, but that has to be the ultimate threat, that can happen. And it's a bit like with the discussions about decentralizations, like devolution. You always get politicians saying, well, we want the local level, we want the regional level to have greater autonomy. It's just that as long as they ultimately have to foot the bill, of course, they're not going to give local politicians the autonomy to just do whatever they like, because politicians at the national level will know if things go wrong, they will be liable, they will be blamed, and the bill will end up on their desk ultimately. And it's the same dynamics in the healthcare system. You can really only have autonomy at the local level, at the level of individual healthcare providers or other actors within the system, if they ultimately bear some of the responsibility, if the better performing ones can grow and keep some of the surpluses they generate, and if the people who make losses have to shoulder those losses themselves.
And this is the new paper, so the Denationalisation of Healthcare. It's kind of a sequel to Universal Healthcare Without the NHS, a book-length piece you did for the IEA. How long ago was that? Do you remember?
2016, I think.
2016, okay. Because it's kind of interesting. You really have been ploughing a lonely furrow, working on these social health insurance issues in Westminster for a while. But what I'm struck by is the fact that actually when I first got involved in this world, kind of mid-2000s or even in the early 2000s, actually people were talking about quite radical NHS reform. And that was also under a Labour government that wanted to reform the NHS. But I do remember quite a lot of free market stuff being written about social health insurance and so on. But probably after about 2006, maybe 2008, the latest, it completely disappeared. So you had a group of people who had been working on this. They all dropped off the map. And you, I think, have single-handedly kept this idea alive. Now, it's not as much as I'd like to sit here and say, and we're going to sweep to victory and we'll have social health insurance by the end of the Parliament. I don't think that's right. Wes Streeting, the Health Secretary, sort of responded to a news story about this report on Twitter with the simple word, no, period. And that's fair enough, right? But this is kind of the essence of the overall, the Overton window. Mm-hmm. If there is a more radical idea out there that is pushing the boundaries of political debate, probably that creates room for politicians, even those traditionally on the left, to pursue market-oriented reforms of the NHS. I don't know if we're going to get them, but I hope we do. And maybe the influence or the involvement of someone like Alan Milburn, who probably is the best health secretary I can remember in terms of market-led reform of the NHS, suggests that the government might inch in this direction a little bit. I suppose in a way my question is not to go way beyond what we've written in the paper, but we do like to think about the bigger ideas and the foundational principles. I wonder whether social health insurance is enough in the long term. I think it is 100% a good reform that we should pursue and which would much improve the quality of healthcare in this country if we were able to shift towards something like what they have in the Netherlands, for example. By the way, it's called the denationalisation of healthcare. I think it's striking that we use the term denationalisation rather than what the critics always throw at us, which is you just want to privatise the NHS, you want American-style healthcare. Now, privatisation, denationalisation, they're kind of the same thing, but I think privatisation suggests to people corporations are going to take it over. It's going to be kind of shareholder capitalism for profit. Exactly. Whereas actually, I think what you propose in this paper is consistent with all kinds of different approaches. Non-profits, mutualisation. You could actually be giving large sections of the health system to the people who currently work in it, for example, and they can be running them as like medical professional cooperatives or something, but within a much more pluralistic system with choice and competition and everything. But I suppose my question is, you have the immediate short-term thing about quality of healthcare, and that's very important. But then you maybe have a longer-term thing of the population getting older, the burdens on the health system and therefore the taxpayer one way or another going through the roof, getting higher and higher. Are European social health insurance models enough to deal with that? Or do you need to be thinking about other stuff? Should we be looking, say, at Singapore and the way people pay directly and save much more for their healthcare?
Yes, so when it comes to the demographic challenges, those systems face the exact same problems that this system here faces. Therefore, I've always said when making the case for a system of that kind, we shouldn't oversell it. We shouldn't attribute qualities to it that it doesn't have. So we should not make the promise that this is going to sort out the demographic problems, because it doesn't. It is still a pay-as-you-go financed system, and therefore, if you have if the ratio of working age population to retired population changes, if you have more old people for every working age person, the people who ultimately finance the system, then you're going to have a problem. And if, say, life expectancy rises, you have people developing more complex chronic conditions later in life, and therefore higher lifetime healthcare costs. That's a problem whether you have a tax-funded or a social insurance system. That's common to both of them.
In a sort of like Singaporean system, you can pay further premiums. For example, if you are obese or if you are a smoker, you pay, you take on the burden of those costs because they're choices that you make. Whereas in a social insurance model like the Netherlands, that isn't the case. You don't pay higher premiums for different lifestyle choices.
That's right, yes. So your health insurer couldn't charge you extra if they know that you smoke or that you go to Kentucky Fried Chicken every day.
Partial to a glass of wine.
Yeah, they couldn't take that information into account when setting the premiums. So therefore, that's also, I've always said, some people on the free market side try to fight against nanny statism on the grounds that they say, well, if we didn't have socialized healthcare costs, this wouldn't be an issue. It's only because we have that system that there is a demand for controlling people's lifestyle choices. They have always said, well, that would still be the exact same issue in a social insurance model. That there might be just a slight difference that this redistribution from healthy to less healthy people, in those systems, that's just a formula, that's just an impersonal mechanism. It's not that people who live in those systems take a great deal of, or make that part of their national identity in the way that the NHS definitely is, where it always comes up in ID surveys, what makes you proud to be British. It's always, well, will be interesting to do the survey now, but so far it's always been NHS number one. Whereas in those systems, even though the formula exists, it is just a formula, an impersonal mechanism. People don't make it part of their national identity, and therefore they're less protective of it, and you would not specifically justify nanny statism on those grounds. So it's a bit less.
It is more so the case, though, isn't it? I think that the reason, one of the reason why we have a lot of nanny state policies and increasing intervention in people's lives and their lifestyle choices is because politicians just believe it is their right to do so. But I also think that the healthcare model does matter, and that actually, because the National Health Service is used as a reason for protecting people, quote unquote, from themselves, effectively. So I do think there is an element of it impacting those kind of policies.
There is, yes, but I think it's more. So you could imagine a system which is also tax funded, but where people just accept, okay, we collectivize healthcare costs. The healthy do pay for the sick. And if that means that you get some free riding, that some people maybe don't take care of their health as much as they should, we accept that, so be it. It's not just the financial implication which make nannying popular. It's more that it's seen as a form of, so living in having unhealthy habits is seen as a form of sinning against the NHS. You're being an irresponsible citizen, which I think wouldn't be the case if we just saw this redistribution as a neutral mechanism rather than something that we somehow, rather than a national symbol that we have to rally around. Even if the amount of redistribution in the system was exactly the same, it still does make a difference whether that is seen as a central feature. That's this institution, and that's part of the national story, part of the national identity, or whether you just have a department in a subsection in the Department of Health which says, well, we deal with risk equalization, but nobody would feel a sense of national pride in that specific mechanism.
I think it's interesting. I definitely encourage any of our listeners to check out the full publication, The Denationalisation of Healthcare, which is available on iea.org.uk. Let's move on to our next topic. So this week on Wednesday, we obviously heard about the inflation statistics. We know that inflation has broadly sort of shifted around that above 2% figure. We also know that on Thursday, we heard from the Bank of England that interest rates are going to remain at 5%. So we weren't going to see a rate cut, which was quite expected, especially after the news on Wednesday. So let's hear from the IEA's economics fellow Julian Jessup to tell us more.
Well, the Bank of England's decision to leave interest rates on hold this week wasn't a great surprise, but I still think it's disappointing. The Monetary Policy Committee seems to be taking the view that there hasn't been enough evidence since the August meeting when they did cut rates to make another reduction. But I think actually there has been plenty of evidence that the economy is starting to slow, that underlying inflation pressures, particularly in the labour market, are starting to ease. And that's not just in the UK, but also in other major economies. So there seems to be quite a sharp slowdown in the Eurozone, signs that the US is weakening, enough to prompt the Federal Reserve, the central bank there, to cut rates by 0.5 point. So I personally would have cut interest rates again, particularly as the Bank of England also announced it was going to be continuing with its policy of running down the size of its balance sheet. That's a process known as quantitative tightening. So I think that would have justified cutting interest rates further as well. I don't think this is necessarily a disaster. In a sense, the markets are doing the bank's job for it. So market expectations of interest rates are falling. That's continuing to lower borrowing costs throughout the economy. But I think there is a risk that the longer the Bank of England waits before cutting interest rates again, the bigger risk of a sharper downturn than we need, maybe even inflation falling well below the 2% target, and then having to catch up with even bigger rate increases further down the line.
Thank you for that, Julian. So we know that the MPC has announced another £100 billion of gilt sales in a process, as Julian said, known as quantitative tightening. Tom, what do you think this means for the rest of the economy?
So I think this is interesting in a couple of respects. So first of all, it's not that they've kept their policy neutral. They've sort of continued to tighten monetary policy, perhaps when people were expecting them to loosen it a little bit. And so that's the decision that the official Monetary Policy Committee at the Bank of England has reached. Now, if you compare this with the opinions that have been coming from the Shadow Monetary Policy Committee here at the IEA, a very different perspective. Now, the Shadow MPC hasn't met this month. I think they met last month. But there was a big majority on that committee in favour of a 0.5 percentage point interest rate cut and a halt to quantitative tightening. So I think the question is why these completely divergent views between the IEA's Shadow Monetary Policy Committee and the official rate setters. And I think it comes down to a different view of how you should think about monetary policy, how you should think about inflation. The Bank of England is operating basically in a paradigm which is all about interest rates. And I think they're looking basically at short-term inflation figures and things in the labour market, and they're trying to balance up all kinds of factors and steer a middle course, if you like. In a way, what I'm saying is I don't think they have a kind of coherent mental model of inflation and how they are controlling it. Whereas the Shadow Monetary Policy Committee, it's not a kind of ideologically homogenous group, but broadly speaking, it is a more monetarist body. So what they're interested in is some form of the quantity of money. That is the way that they're thinking about inflation, deflation, and the impact of monetary policy on the economy. And I think when you look at the monetary aggregate, so if you look at broad money at the moment, its annualized growth rate is about 1%. Now, to put that in perspective, the 10 years from 2010 to 2020, broad money grew at an annualized rate of about 5%. From 1981 to 2022, average annualized growth of about 8%. So money growth is extremely low by historical standards at the moment. By the way, those figures are coming from Tim Congdon's Institute of International Monetary Research and their monthly notes that they put out, which are a really good source for monetarist analysis. Now, as he said in his most recent note, these money growth figures are more consistent with recession than with an economic bounce back. And so I think that's why our Shadow Monetary Policy Committee is thinking that the bank should be much more aggressive in cutting rates, in halting quantitative tightening, and basically easing the stance of monetary policy. Because bluntly, people of a monetarist persuasion, I think, are sensing overkill, that the bank is still fighting a war which is well and truly finished, and because monetary policy impacts kind of real factors in the economy with a fairly lengthy lag, they've whipped inflation through policy changes or decisions they've already made. Now, potentially, they're driving us into the ground. I'm probably a bit more worried than Julian was in his comment there, but I think that was a very finely balanced judgment he gave us. The other thing that I like to look at as well, so one of the reasons that monetary policy is interesting or maybe frustrating for libertarians is that there isn't a free market view. You've got very mainstream people who are sort of basically kind of neo-Keynesian but more free market with it. You have monetarists. You have a lot of people in the free market movement, particularly in the US, I'd say, who are looking at nominal GDP and trying to use that as a guide for monetary policy. Now, if you look at market forecasts of nominal GDP in the UK, they're around 3.5% for each of the next 3 years. That kind of suggests that the stance of monetary policy is more or less okay. It definitely doesn't suggest further tightening, though. But then, of course, there are lots of libertarians who think this whole conversation that we're having is a disgraceful aberration, and that we should have started this conversation by saying, of course, the Bank of England should be abolished and we should have free market money. Interest rates should just be factors of supply and demand, or a product of supply and demand. And we should get the government out of this business of trying to micromanage and fine-tune the macroeconomy. And I do have a great deal of sympathy with that point of view. It is a hard view to make practical. And that's not to say that it's politically beyond the pale. Of course it is, but so are lots of great ideas. This one, I think, though, is quite hard to actually work out how you put it into practice. As my old boss, George Selgin, said, if you could wave a magic wand and bring back the classical gold standard, you would. Given that you can't, it's quite difficult to know how you make a free market monetary system work. And so you fall back on these rules of thumb, I think, around broad money growth or targeting nominal GDP.
Could you just explain, just on the first instance, what broad money is and why the MPC should be looking at broad money as opposed to what they're looking at now when it comes to the supply of money in the economy?
Yeah. I mean, basically, broad money is all the deposits that people have available for spending. In very simple terms, that's what it is. So that's the kind of money that's available to spend. And that has a very clear and well-established link with inflation, with nominal GDP, and so on. The IEA published a really good book recently by Tim Congdon, already mentioned on the podcast, which was The Quantitative Theory of Money, a New Restatement. And that was kind of harking back to Milton Friedman's, I think, 1956 restatement of the quantitative theory of money. So, you know, I think the important clarification to draw, and I think Tim does it well in his book, is I think monetarism took a bit of a beating intellectually in the wake of the financial crisis, because a lot of self-described monetarists looked at quantitative easing and the huge increase in the monetary base in the US, but in the UK and Europe as well. And they said, well, the money supply is increasing, we're going to get inflation, and this is terrible. Now, of course, it didn't happen. Actually, central banks for a long time were probably struggling more with deflation in the wake of the financial crisis, certainly with nominal income growth, which was extremely sluggish, which to a lot of people would suggest actually that monetary policy was too tight. I think Tim and other broad money monetarists would say the intellectual error there is to focus on the monetary base, which is a tiny part of broad money, and one which you can't really show a very clear link between that and macroeconomic outcomes. If you look at all deposits, that has a much clearer link and much better predictive power. And so I'd recommend people take a look at that publication.
That's really interesting.
Yeah, but that distinction has always, I think, existed in the history of this institute, that there were the monetarists, the people who do believe that there should be a monetary policy and a state currency. Those are the Chicago school leaning people. And you have the Austrian school, the Austrian economics, Austrian School of Economics on the other side, who would just not have any kind of government currency. Who would say, well, money should just be whatever people accept as a medium of payment. That is money, and that should emerge in the market. Historically, it's been gold. It could be something like that again. And then, of course, viewed from that perspective, yes, these discussions, should the rate be a quarter of a percentage point higher or lower, would seem like Soviet planners talking about whether the tractor production quota should be a bit higher or lower. I've never been able to work out where I stand on that divide. I just don't know nearly enough about it. And there's also, as you said, this is quite remote for now, and it's not exactly a priority issue. Instinctively, the Austrian perspective sounds more appealing if you're a classical liberal, and especially in times like this when you have experts arguing with each other, where and it is a bit odd for us to say, well, this expert is right, that one is wrong. That's not the way we normally do things. If people talk about the price or the quantity of anything else, it is a bit of an aberration. But then a Chicago-leaning economist would say, well, yeah, but we've had the gold standard for a long time. And they would say what we have seen is that in some periods, recessions under the gold standard were deeper and more prolonged than under a fiat currency system. And so therefore, I would also say, well, if that's true, and I can't really judge it, I'm sure an Austrian economist would have counter arguments again, but if that's true, then fair enough. It's not that I'd be ideologically wedded to any one monetary framework.
And I don't think we should probably go down this potentially a rabbit hole when libertarians start talking about monetary policy. Often this can spiral off into the wee small hours or something. But I will just plug, I think this is probably my third IEA publication plug, The Experience of Free Banking, edited by Kevin Dowd, which we did a new and expanded edition of, I think in December or January this year. Again, great compilation of pieces about more free market monetary systems that have existed in various times and various places.
Yeah, I think it's really important to point out, and I think you are right, it is very easy for any of us to get into the rabbit hole, but it is important to point out that there have existed economic systems in which the supply of money was not decided by a central bank. And we saw that happen in Scotland for a period of time. We saw it happen in Sweden for a period of time. We saw it happen in the United States for a period of time. And broadly speaking, the supply of money was decided by the market, by supply and demand, and we saw a much more stable economic system, more broadly speaking. But I do think that we should refer back to that book specifically. I do just want to touch on one other thing. So, with regard to inflation, I think it's undoubtedly clear that the fact that the headline rate is now at 2.2%, I think it's undoubtedly clear that the supply of money has a direct impact on the rate of inflation. And I think that when we're thinking about the fact that the Bank of England have underwent a process of quantitative tightening over the last year, and we saw inflation at double figures no less than a year and a half ago, and now we are seeing it come back all the way down to 2.2%, I think it's undoubtedly clear that there is that connection between the supply of money and the rate of inflation.
It may be clear to you. I think, unfortunately, it isn't clear to a lot of people, and that's embodied in the fact that there's really very little discussion about inflation, even though we've just gone through a massive experience of it. And I should say there's no real sort of intellectual discussion of it. There's not a lot of people striving to kind of work out the deeper truths behind it. I think most people just lazily assume, or maybe it's unfair to call it lazy because it does just seem like common sense, that things have been expensive because we've come out of a pandemic and there have been labour shortages, and the Suez Canal was blocked for a while, and there's a war in Ukraine, etc., and gas prices spiked, and that filters out through the economy. People kind of hear that argument and they think, well, that stands to reason. Don't blame central banks for that. Actually, in a very real way, this is the central bank's fault. Now, they're not necessarily in an easy position when they suffer those kind of adverse supply shocks. But while supply shocks of that sort may change the measured price level in the short term, and that's kind of just a product of the way it's measured, medium term, actually you would expect relative prices to change, but the overall price level to remain pretty constant, all else being equal. So what you would get without the central bank accommodating the supply shock through an increase in money is effectively prices of those things that are in short supply would go up, but because people would have less money to spend elsewhere, prices there would fall. Now, of course, this is another way of saying that everyone is just getting poorer. And that's why, as a rule, central banks don't allow that to happen. They will accommodate negative supply shocks, and so they'll increase the money supply to offset it, and so you will get some inflation. Nevertheless, this is a policy choice, and when you get inflation that has gone way beyond the real impact of the supply shock, as we experienced in Britain, as they experienced in the United States, by the way, most of the Asian economies saw very little inflation, even though they're part of the same global economic system that suffered these shocks, right?
Switzerland didn't either, and that's probably an even better example. So there were policy mistakes here, there were policy choices here. I think this really needs to be discussed and investigated because it could so easily happen again. It's most likely, actually, that I think we'll overcorrect and we'll get a monetary-induced recession that could have been avoided if we had understood these issues better.
That's not a prediction, by the way. I don't make economic predictions.
And if the Bank of England had responded more quickly to those changes, I think is the point. Well, I certainly look forward to the Shadow Monetary Policy Committee meeting, next meeting, and looking at their meeting notes. And
can I just have one short point to that? Because I have seen that some people were a bit surprised that because we are generally, to the extent that we have views on monetary policy, we're associated with hawkishness. I think some people, a lot of people who follow this would have expected us to say, no, rates should go even higher, and until inflation is at zero or something. I don't think there's anything inconsistent about monetarists, Chicago-leaning economists now saying, let's not overcorrect, because that is basically their approach, that the rate of monetary growth should be low but stable. So they wouldn't have had the expansion of 2021. But also, by the same token, it's not inconsistent if they now say, let's not overcorrect for that now. And therefore, there's no contradiction there between a monetarist. I'm guessing Julian is a monetarist. I haven't asked him, but it sounded that way. Nothing inconsistent if he now says the Bank of England should go further in cutting rates. That's just, I've seen some people are a bit confused. George Monbiot has seen that the Shadow Monetary Policy Committee now being less hawkish, a bit more dovish than the Bank of England, and he now thinks he now has to be hawkish on monetary policy somehow, just so that he's not on the same side as we are. But yeah, I don't see any inconsistency there.
There isn't, and I also think there's no consistency with the perspective that actually, inflation in very layman terms is that there's too much money in the economy chasing too few goods. That means that by definition, as goods and services increase in the economy and as more of them circulate, the supply of money will change. Nobody's saying the supply of money should remain fixed forever, but there are questions about how the supply. Some do say that. No one's seriously saying that. But there are particular perspectives that actually it fluctuates and it adapts as the economy changes, and that's the exact point of monetarists. Let's move on to our third and final topic. So Wednesday was Equal Pay Day, and the Chancellor Rachel Reeves has sort of announced this Invest in Women task force, which is sort of part of a number of different packages. The task force basically is aiming to create a funding pool of more than £250 million just for female-founded businesses. And it's all part of the Rose Review, which actually found that it was an independent review that found that female entrepreneurship, if they were to have a £250 million boost, that could be added to the economy if women started and scaled their businesses at the same rate as men. So that's what this particular review said. I think what's interesting about just this entire package, and we won't go too much into the detail of the Invest in Women task force, but Rachel Reeves' aim is to tackle the gender pay gap. And I think what's really interesting about this is it seems to me that the gender pay gap is coming back into sort of the news around the fact that it exists in the first place. Now, according to the ONS, their figures last year, the gender pay gap is around 14.8%. For full-time work. Now, the problem with these statistics is they come from the government's compulsory gender pay gap reporting measures, which require all companies with more than 250 employees to publish their gender pay gap. Now, this doesn't take into account key differentials like full-time and part-time work. It doesn't take into account key differentials like the type of experience that those particular people have, or indeed the type of job, the experience they have in that particular job, or indeed their qualifications. So there are so many different factors, as we know, that go into a particular person's pay. And what I find really interesting is that Claudia Goldin, the woman who won the Nobel Prize in Economics last year, argued in much of her literature that actually one of the main reasons for the gender pay gap is that, surprise, surprise, women tend to take time out of the workforce to have children. And so we cannot solely attribute the gender pay gap to discrimination, and actually the majority of that difference in pay between men and women is as a result of choices that women make. And I think that's really interesting. It was coming back into the news this week, of course, with Equal Pay Day. I mean, it does sort of bring up wider questions about who deserves what when it comes to pay. And of course, the free market answer is, well, supply and demand decides wages in the same way as any other product or any other price, so to speak, in the market.
Yes, and I think as we've said on a few recent editions of this, I think it's one of the disturbing trends in modern politics, the degree to which politicians are seemingly quite content now to interfere with market price signals, to get involved in the labour market in particular, to politically or bureaucratically try and influence wages and so on. Now, I don't think there's anything wrong with the government preventing kind of direct discrimination. I think actually it's vanishingly rare in the UK and probably in most developed countries as well. But there may still be instances where women are actually discriminated against in terms of pay. I think that those businesses would suffer in the market and get their comeuppance that way. But if government wants to redress that balance, fine by me. But I think what we mostly see is politicians kind of tilting at windmills, actually. Trying to find gender pay gaps or race pay gaps. I think they've talked about disability pay gaps and stuff recently, which either don't exist at all, are the result of the ways the statistics are compiled, or are just a reflection of realities. Like you say, for example, that women often take time out of the workforce to have children, and that will probably somewhat suppress their pay over the lifetime and so on. Because the problem is, of course, if you try and equalise all of these things, what you're actually doing is making the supposedly disadvantaged group more expensive to employ than normally the male group or whatever. And that you would expect that to have perverse, unintended consequences. I think there's one other thing that I just want to mention here. And if anyone spotted me looking at my phone while you were introducing the topic, I'm going to excuse my rudeness because I was looking for kind of a statistic I'd seen recently. And I think I mentioned this to you, Kristian, that I was shocked, truly shocked to discover the third biggest item of public spending is so-called economic affairs, which is something that includes spending on business and industry. Now, you wouldn't expect in a broadly free market economy the government to be spending an awful lot of money on business and industry. In actual fact, it's if you round up, it's 8% of total managed expenditure on business and industry. Now, it's about 80-odd billion pounds a year. Now, it includes things like the energy subsidies. That's a big chunk of it at the moment. It includes things like farm subsidies. But it also includes a whole host of different government interventions in business and industry, which are, I think, almost impossible to justify from the free market liberal economic perspective. And I think it would be interesting to look into this in greater detail. Also, by the way, because that direct spending probably it might include the 250 billion female founders fund that you're talking about. I don't know how that's structured. But generally speaking, these kind of things wouldn't be included in that overall amount. These are costs that are being imposed on business by government. They're not direct fiscal costs, but they are nonetheless real economic costs. And so it's just an example of the fact that there is this huge swathe of government that really should not exist.
So, I mean, we can repeat that for many different government departments. I just want to also add, I think what's really interesting about, you sort of alluded to it earlier, Tom, that there are these whole host of unintended consequences as a result of these particular measures. And you're talking about this huge waste of effectively taxpayer money on these sorts of initiatives. But also just going back to gender pay gap reporting, this is effectively the government forcing companies to publish data that doesn't tell them the full truth. So it doesn't tell anybody the full truth. And there are countless examples of companies being named and shamed in the media as a result of this figure that basically doesn't tell us anything real about the differences in pay. So EasyJet is a really good example. There were these huge headlines across the FT, across the media, that EasyJet reported a pay gap of more than 45%. And people were sort of all up in arms about it. People were probably off to Ryanair instead. But actually, what's really interesting is that if you just scratch below the surface, looking at the detail of where that 45% figure comes from, you can very, very easily find that male and female pilots are paid exactly the same depending on their level of experience, and male and female cabin crew members are paid exactly the same. It's just that female cabin crew members make up the majority of those particular jobs. Now, we can have a conversation about why there are so few female pilots in comparison, but that isn't the same thing as discrimination. And I think that is what really needs to be made clear as a result of this. And there are a whole host of unintended consequences. It means that businesses are going to try and adapt that headline figure, which means they are probably going to hire less women at junior positions. They are probably going to hire less women internally with those particular jobs and outsource them instead on potentially less secure contracts.
There's a problem with economic aggregates, with big economic aggregates where you just look at the headline figure without knowing what's beneath it, how that comes about. So I remember this was, in fact, one of the very first IEA publications I've ever read. Len Shackleton's book, Should We Mind the Gap? On the gender pay gap, 2008, it must have been. And he starts by, I think it must have been the first chapter, he just cites a survey where students at university are asked, what are you looking for in your future career? What are the things that you prioritize? And there was a big gap between male and female respondents that the men were much more likely to say they're interested in pay, they want to make money. And there were just more women who said they prioritize other things. No, there's nothing wrong with either of those preferences. It's just if people make choices on the basis of such preferences, you would expect there to be a gap. And it doesn't mean that there's anything wrong with it. That is just what you would expect. And since then, I mean, back then, this discussion was pretty much limited to the gender pay gap. And after the Great Awakening, that kind of logic that every time there is a gap between any two groups, however defined, it must be because one group is discriminated against. That logic was just spread far more widely and applied to everything. And that is the problem. Most of the time, if you look at it, what is behind these gaps, the answer is it's something quite harmless. It's like in this case, it's just different choices. And then later on, the motherhood gap, which is where most of this later on comes from. It's not that there's discrimination against any particular group. It's just for whatever reason, sometimes people make different choices. Individuals make different choices. And sometimes that correlates with some characteristic that people of one demographic group on average make a particular choice more often than people in a different demographic group. And that leads to differences in some economic outcomes where I would just say, well, so what? What's the problem with that?
Yeah, it's interesting. I think the motherhood gap is something that Claudia Goldin highlights specifically, and it's incredible that she won the Nobel Prize in Economics for it. That's part of why she won the award. I think it sort of shows that actually maybe there is an Overton window shifting on the gender pay gap too, at least not necessarily for Rachel Reeves. I think we're going to leave it there. Thank you so much, Kristian and Tom, for joining us today for an additionally long IEA podcast this week. And thank you to all of you for listening and watching. If you're interested in looking at any of the publications mentioned in the podcast, or indeed any other IEA publication, then you can check them out on iea.org.uk.